There's been a lot of talk about inflation lately, and billionaire investor Bill Ackman just warned about it. But don't worry, it's not all bad news. In fact, during a recent full-length interview, Ackman discussed a wide range of topics, including inflation. So you'll get all the juicy details in this video. Make sure to stick with the video until the end. Let's get started. Are you still calculating 30-year interest rates? It seems like there are a lot of factors that could cause interest rates to rise even higher. For instance, there's a possibility of a government shutdown, which means all those little government agencies won't be able to provide data to the Federal Reserve. And guess what? The supply of bonds is at its worst technical environment ever compared to the number of buyers. China, Russia, and even Saudi Arabia are selling bonds too. On top of that, the economy is still going strong and inflation is persistently high. It's like a dark period for bond buyers, right? So our view is that you're not getting enough reward for entering into a long-term contract with the US government at a fixed price. Pretty wild, huh? We've been in this crazy time with super low interest rates where everything just seemed cheaper. But now, with inflation running higher than 3% in the long term, a 4.7% interest rate doesn't make much sense, right? The Federal Reserve's goal was to avoid deflation and aim for 2% inflation, but then the pandemic hit, and we saw trillions of dollars in fiscal stimulus. Plus the psychological boost of being able to freely roam after being locked up. It's been quite a roller coaster, huh? All of these factors combine to cause inflation, and we still have massive deficit spending and infrastructure spending. The government is selling hundreds of billions of dollars worth of securities and bills, and eventually, they will have to sell more and more of the longer instruments. If you look at the Federal Reserve's balance sheet, you can see that it is in an imprudent balance sheet. If this were a business, you wouldn't have so much short-term debt, at least 1/3 of it, and you wouldn't have to reprice. We agree with you. Stepan did a pretty good job as Treasury Secretary, but we think he missed one important thing. He should have issued a ton of super long-term bonds like 30-year, 50-year, or even 100-year bonds at crazy low interest rates. I've been hearing a lot of investors talking about this too, like Ken Griffin and Rick Reed. They're saying that because of the massive amount of bond issuance, we might see much higher real rates for a longer time than people expect. It's something to keep an eye on. The world is changing and inflation seems like it's going to stick around at higher levels. It's like we're in a whole new era where interest rates that used to seem high now feel super low. It's crazy to think that 4% used to be considered high. So it wouldn't surprise us if we started seeing 30-year rates. Well, going up too. It's a whole new ball game. Things have been moving like crazy lately. We've seen some big shifts in the past few weeks with rates approaching the 5% mark. It's wild how quickly things can change, right? And you know what? People used to automatically buy the 30-year treasury whenever they sensed a recession coming. But let me tell you, it's not meant for short-term speculation. It's more like a long-term commitment with the US government. The world has changed and inflation has been climbing at a rate we haven't seen in ages. It's a different ballgame now. Give them a call. Money managers in the country set out to keep inflation at a consistent 2% annually. They found it difficult to achieve this goal, which made some people think that rising prices wouldn't be a big deal in the future. In reality, inflation is primarily determined by how much supply there is compared to the demand for a given good or service. Prices rise, for example, during 2020 and 2021. The government made it easier for people to have money through direct payments and low borrowing costs, which meant that more people had the means to buy things like used cars, while car manufacturers struggled to get the parts they needed, resulting in fewer new cars being made. With fewer new cars, people kept their older ones longer and the number of used cars for sale decreased. This mismatch resulted in a spike in used cars. He has a sense that the rising prices all around us aren't just a passing fad. He's looking at the larger picture and noticing a slew of changes that point to this. The entire world is in a state of flux. Things are shifting politically and economically in ways we haven't seen before. And it's becoming more expensive to manufacture goods overseas, which used to be a bargain. At the same time, people who work for a living are standing up for bigger paychecks, which is also changing the game. There's the big leap towards green energy, which isn't cheap. And, have you seen the petrol prices lately? They're so high that everyone's starting to think that digging deeper into our wallets might just be the way things will be from now on. Those folks at the Federal Reserve are always trying to keep our money valuable. They might just keep cranking up the cost of borrowing money to cool things down a bit on the price front. They've been able to tackle inflation for now, but if Ackman's right and prices stay high, we might see interest rates climbing even higher. That can make investors a bit nervous and send the stock market on a roller coaster ride. But you know what? Ackman doesn't seem worried. He thinks we'll adapt to this new money landscape. It's like we always find a way to navigate through these ups and downs, right? So don't sweat it. When it comes to bonds and yields, owning businesses with pricing power is key. Those are the ones that can thrive even in a world with 3% inflation. Managing a business becomes trickier when inflation is all over the place or crazy high, right? But the good news is that many companies can still do really well with a 3% inflation rate. It's like they're earning royalties. Take Universal Music, for example. They get a tiny fraction of a penny for every song streamed. It's like they're royalty in music. And companies like Google and restaurant brands earn royalties on advertising and people eating at their various concepts. It's a pretty cool way to think about it, don't you think? Ackman sure knows how to play the game and make those big profits. His $1 billion investment fund is focused on just 7 companies, but it looks like 8 because of his investments in different classes of shares in Alphabet. He's got a mix of eateries like Chipotle and Restaurant Brands International, which includes Burger King, Tim Hortons, Popeyes, and Firehouse Subs. And he's also invested in Hilton, L. Howard Hughes, Canadian Pacific, and Alphabet, the parent company of Google and YouTube. Talk about a diverse portfolio. But here's the interesting part. After analyzing Ackman's picks, it turns out that these companies have 2 key characteristics that can help them not just survive, but actually benefit from inflation. The first is pricing power, which means that they can increase prices without losing customers. And the second characteristic is their ability to adapt and perform well, even if inflation rises. It's like they're ready to tackle anything that comes their way. Pretty smart, huh? Ackman's investment in the railway company is a smart move. With its essential service of transporting goods over long distances, it's often the preferred choice over more expensive truck deliveries. This gives them the leverage to charge more when necessary. And speaking of pricing power, Chipotle is another one of Ackman's picks that has shown impressive strength. Despite menu price increases during peak inflation times, they've managed to keep their dedicated customer base intact. As Warren Buffett said, if you can raise prices without losing customers, you're onto something good. Now let's talk about the second feature to look for, an asset-light approach. These are companies that don't require a ton of expensive physical assets to function. Take the airline industry, for example, which is on the opposite end of the spectrum with its heavy reliance on assets like aircraft. But companies like Restaurant Brands International, RBI, another one of Ackman's choices, follow a franchise model. They don't have to own the physical restaurants, local franchises do. RBI simply collects a portion of the sales without the burden of property and equipment costs. Ackman's moves are worth keeping an eye on for any investor looking to sharpen their strategy. It's always exciting to learn from successful investors like him. That's it for today's video. If you want to stay updated and receive more videos like this, make sure to hit the subscribe button.